recession hit 3 months later. Pretty idealized chart. So as the market's going into a recession, bonds start moving up. At the very bottom, stocks start moving up. Then commodities, they're the last one to start coming up. And then bonds peak first, stocks peak second, commodities peak last. The caveat, deflation. When the macro trend is toward deflation, or sometimes even disinflation, bonds and stocks, they will actually trend in opposite directions. Generally, they'll trend in the same direction, i.e., what they've been doing since like 2000, since the recession. Real estate, they normally have their own agenda. They'll usually follow the trend of long-term yields and inflation and deflation expectations. So where are we right now? Let's see. Have bonds topped? Maybe. Are they topping? Perhaps. It's pretty hard to tell with what the Fed's doing, but stocks. We'll just use the 4-year cycle. In terms of the 4-year cycle, the recovery started in 2008 and 2009, so that means that we should be at the next bottom in 2013. So where are we right now? Late bull market. What's another way that we can tell this? We can say that what sector is leading right now? Technology, consumer cyclicals, what else? Financials, not really. Capital goods. They're all doing really well. If they're all doing really well, what does that represent? About the middle to late end of a bull market. Confidence is coming back to the economy and going into more risky stocks. As you see right over here, I think that XLI, industrials outperforming, materials, tech. We have consumer discretionary right below it. So those are the best, and actually we have so-called defensive stocks doing the best earlier in the recovery. What's this blue line right here? Financials. Everyone keeps saying we need a rebound from the financials. They just haven't come back to where they were. They had their time. Now you see they're underperforming. And actually the one that is really underperforming is, let's see, consumer staples, which they normally only do well in a bear market. And energy is actually lagging pretty much too. And this is called a relative strength chart. Got to put this out here. Pattern analysis. Gold, right now, according to previous probabilities, has an 84% chance of hitting $2,100. It makes sense. We're in the late end of a bull market. Commodities, they're going to go up. Especially with helicopter Ben dumping money on us. Okay, so right here we have cycles. Note that this is a pretty old chart. I said that gold would bottom on April 1st. Look at the chart. Look at the chart. April 1st. That's when gold bottomed. I did this in February. But anyway, that's a buy signal right there. Oh, and FYI, if you do a cycle analysis on the S&P 500 right now, the actual trough is going to be around the end of April, about like April 25th-ish. So that's when we're going to start seeing a new up leg in the market. So why talk about all this? Why do I do this? Why did I drag all you tonight? Over 60% of PhDs, they don't believe that technical analysis can be used as an effective tool to enhance investment performance. However, I have yet to meet one that spent years studying it and applying it. And even if we're not turning students into technicians, to make a more well-rounded student, one that's better prepared for the job market, why not go over it a little bit? And also, I wanted to mention this stuff because last summer officers of the Smeal Traders Association, which I'm an officer in it, we really try to create a class for students to learn about technicals. Most of the faculty, even they either chose to ignore all communications, or they just said absolutely not, and they actually went the route of embarrassing us. The fact is, even though this is coming back into the job market, even though this is absolutely demanded, academia is just, they're behind. They're teaching their students to become professors, which there's nothing wrong with that if they want to become professors, and not real traders. And the fact is, you can't simply ignore what is being used in the market. And actually, I need to drop a bomb right now. I'm presenting to an empty room. I invited 40 finance professors to this meeting, and not one showed up. So I'm doing this video now to send to them because this is a very important topic that needs to be covered. I want to mention that also personal biases and beliefs, they shouldn't dictate the curricula of schools, but rather the demands of the job market. This was a survey that was done in 2006, I believe. Notice the most important topics for professors: portfolio theory, discounted cash flow, cap and beta, required rate of return, discounted dividend discount models, efficient markets. Those were the top. For practitioners, they were actually the lowest. They were actually in the lowest 8. The most important ones to practitioners: support resistance levels, trend lines. Next after that, overbought, oversold, volume tracking, and charting, and crowd psychology. There's a mismatch here. There's an absolute mismatch between what's being taught and what is being used. My bottom line is that at this point, the finance program, and to other finance people that look at this from other schools, check to see if yours is in the same situation. The finance program is falling short right now. While we do teach students for a lot of different careers, we don't talk about common market timing tactics or how to even make a macro judgment of the state of world markets. But the job markets demand these skills. I actually had an interview, and the first question, actually, let's see, the first question, now that you know that I'm in an empty room, that I was asked was, so, where do you think the market's going? And what did I say? 13,721.34 cents on the Dow Jones by this September. The person who I was with, he burst out laughing, and he said, that's the same target as me, but how about July? If you can actually support what you're thinking and not just say, well, it looks like the job market's recovering. I read in the Wall Street Journal the other day, this, that, this, we already said that the stock market really discounted that stuff 7 months ago. So we need to teach students how to make a macro judgment. Now, of course, everything I've said, the finance programs still teach for a lot of different career fields like personal wealth management, like MPT, banking, real estate, venture capitalism. Actually, Penn State's venture capitalism curricula is fantastic. Corporate finance, a little bit on arbitrage. We spend a lot of time doing pricing models, and fundamental analysis and that kind of investing. All right, so please look into what could possibly, how technical analysis can make your students better job candidates, more well-rounded, more opinionated, or more ready to give an opinion about what the market is going to do, should do, and it'll be a great advantage to them, and you'll be doing them a great service. So that's all I have to present. I thank you for your time. If you're watching the video, floor's open, any questions, and this is my email if you want to ask about anything technical, or even like the CMT program that I'm in, or what I do, or if you want to send me a stock ticker and say, how would you look at this? CYD 5077 at psu.edu. Thank you so much for watching.